Alrighty, welcome everyone. We're ready to get started on our webinar today. I'm Talia Quigley, Client Success Specialist here at HousingWire, and today we are lucky to be joined by Mortgage Capital Trading to discuss strategies for MSR management in 2021. So just a few housekeeping items before we get started. We'll be having a Q&A session at the end of the webinar, and you can submit questions at any time by clicking on the Q&A icon at the bottom of your screen. Also, we will be sending out the recording and presentation within the next 24 hours. Today, we are joined by 4 industry experts, and first we have Phil Laren, Director of MSR Services at MCT. Phil is the architect of MCT's state-of-the-art or industry-leading MSR technology, and during his career has structured hundreds of bulk MSR transactions. Next, we have David Burruss, MSR Sales Director at MCT. As Director of MSR Sales, David is responsible for marketing outreach and acquisition of new customers. Next, we are joined by Matt Danilovich, CEO at Doorway Home Loans. Matt is a seasoned CEO with a well-recognized history of startups, turnarounds, and consolidations. Last, but certainly not least, we are joined by John Davis, VP of Secondary Marketing at Envoy Mortgage. John has over 30 years of experience in mortgage banking, primarily in capital markets, with emphasis on MSR and whole loan valuation and analysis. Now I'd like to hand it off to Phil.
Hey, thank you very much, Talia. Can we go to the next slide? Get started. David, why don't you, Dave Burruss, why don't you walk us through what we're going to talk about this morning, and then I can jump into some of the details as we go on.
That sounds great. That sounds great. Well, we're looking obviously to give an update to the MSR market, kind of what's happening. Really, a lot has happened since last year. So many stories for all of us. But we're going to try to cover some of that background and bring up to speed on current events and things you need to keep an eye on going forward for the rest of 2021. Certainly included in that will be an update on the CARES Act, watching the lasting effects of the pandemic, and certainly entering on stage right here this last several months will be CFPB and what their potential impact can be for the year. And then certainly looking at the expectations for 2021. We're looking at what the market contains, and particularly as it means to MSR and the directions it's taken. So we want to give you some more color on that so you can take advantage of upcoming opportunities. I think clearly a big impact is going to be how the $1.5 billion cash window delivery limit impacts the servicing arena and how to manage around that. So. And then in the middle of all that, wanted to give you an update on the bulk activity for MSR sales that are taking place, really kind of events that we started seeing unfold late fourth quarter and then certainly into the first quarter, and what we look as a forecast into the rest of the year. So with that kind of overview, Phil, I'll turn it back to you. And if we can go to the next slide, thanks.
Thanks a lot, David. Yeah, as David mentioned, the big event of 2020, of course, was the pandemic, and its effect on our mortgage market was very dramatic. We're still seeing some of those effects, and some of the slides later in the deck will go into a little bit more detail on some of those effects. But the most obvious impact in the spring was the pullback of the aggregators on paying for servicing, essentially because of all the risks associated with potential forbearance and potential that would be, and along with that, cash advances, perhaps foreclosure moratoriums. All of that created a pullback of the aggregators. As the market stabilized over the summer, we saw things weren't going to be as terrible as we thought. I will say, when we at MCT did our forbearance projections early in the springtime, we utilized research based on hurricane and floods of 2017 in Florida and Texas, and how that forbearance activity was impacted by those natural disasters. And applying those same numbers, we were anticipating fall forbearance numbers in the over 20%. And fortunately, that never happened. We kind of peaked in the low teens for for Ginnie Mae's that are for government loans, and maybe the high single digits of 10, 11% for Fannie Mae. And currently, we, rather than being up from 20 and coming down slightly, we peaked and never really left the single digits on average more than a couple of weeks, and now we're in the 5% range. But that impact did certainly change the way our seller servicers are acting, and that that hits on the second bullet there, that servicing asset is a key and in the best exit analysis. So the aggregator pricing has come back some, but the servicing retention is now stronger than it's been in the past. But with all that, we do have to look at the CFPB. There's a kind of a new kid in town, or however, change of control, as they say in the business world, but in the political world, that means a new face on the CFPB, and they've already announced their intentions to more aggressively look at, in particular, at servicers in their response to the pandemic. So we'll get into all those topics in more detail. If we go to the next slide, I can spend some more time on it. I've already outlined some of the forbearance issues and the challenges, but the CFP drilling down, they announced in January how they intend to look more at servicers, and not just mortgage servicers, but student loans and other servicers of other financial assets. But in the servicing world, they want to make sure that when borrowers apply for forbearance, they were not challenged. There was no proof of hardship required, as it has been in past forbearance. You just told the servicer that you were affected by COVID in some way, shape, or form, and therefore you needed to delay your mortgage payments. So there were those concerns, and then the renewals of those forbearance, you have to give the borrower the right to renew. And did you reach out and contact them properly? Did you not charge any late fees? And all of these, apparently the CFPB has had anecdotal or incidental information that from time to time, the guidance of the CARES Act has not been fully followed. I would not be surprised, given that for certain servicers are servicing thousands of loans, some 10,000, some hundreds of thousands, even a few at $1 million or more. When you have that many clients, there's going to be some misses, and so that's that is going to be causing some awareness that we have to worry about going down the road. I would say, my sense is that most servicers are trying to diligently handle these, but as with anything in servicing, it varies from entity to entity. But I think the key takeaway for this group, for the sellers and servicers on the line, is that most of you are utilizing a subservicer to service, and it probably bears reminding that even if the CFPB identifies that your subservicer has committed some failure to abide by the CARES Act forbearance instructions, then you as the servicer are also responsible, every bit as much responsible in the eyes of the agency and the CFPB. So that kind of the takeaway then is you really have to monitor your seller service, your subservicer much more intensely than in the past, which you probably were already doing. And so kind of with that as a background, maybe we can hear from our two seller services here, Matt and John, as to whether how they're dealing with these kind of pandemic issues. Maybe Matt, you can start. I'll pass to the next page.
Sure thing, Phil. Yeah. So, it's easy right now from the perspective of a year after the panicky period that we experienced in 2020 to kind of put it all in perspective. But I think one of the most significant things that we all can remember, if we put ourselves back in time, is just how uncertain everything was at around this time last year. We really didn't know what was ahead. And so, I would say that the MSR strategy that you take can really help to bring some stability and even a bit of clarity to times of uncertainty. And I think that looking back, again, with a lot of help from MCT, because we really leaned heavily on you guys during that period, we were able to have just a little more clarity about the path forward with our MSR strategy. Frankly, in our particular case, we had no choice but to retain pretty much our entire Govy production, because again, there's just so much uncertainty about the future and what forbearance would look like. You guys will recall that at one point we weren't even sure whether the government was going to back forbearances. So we had no choice but to take a strategy, especially as aggregators were pulling back from the market, a strategy of really focusing much more heavily on our servicing initiatives and really looking to build for the future, during a time of uncertainty.
John, did you have any comments?
No, we've got a team that pretty much handles all the forbearance through Loan Care, our subservicer, and I mean they've got the forbearance expiration slotted by month and basically know what each and every loan qualifies for in terms of coming out of forbearance, and I mean they've got a pretty good handle on that, and I'm hoping we don't see a lot of spike in delinquency when these things start to exit forbearance. That's what we're hoping. Not sure if that'll be the case, but we'll see. It's going to be interesting to find out.
And John, did you have to allocate extra resources to kind of monitor the subservicer with all this forbearance?
Yes, we've got actually 2 people just for going through the forbearance items that the servicer's handling, and of course they're charging for every little thing that comes through. So
I think
rather expensive on the servicing side.
I think Phil, what we experienced is that we had to do a number of things in other areas. For example, we had to shore up our loan loss reserves. I mean, there were some financial implications to to retaining servicing that had to be part of our calculus. And then in addition, we had to make some changes in operational processes. I mean, we had to make sure that we were really tight in our underwriting, and you're always a little bit tighter in your standards when you're going to be the one servicing the loan versus selling it off. So I'm probably no one might like to admit that, but that's the reality of what you do when you're doing your own servicing. You tend to take a little more care and establish different kinds of standards and expectations when you are going to be holding that loan.
Absolutely.
Makes sense. Hopefully none of your your buyers are on the line right now.
Right. Well, they're bigger. They can afford more risk than we can, right? So right. So you have to turn that risk dial to match the profile of your company, And again, the big guys can accept a little more of that risk sometimes than we smaller independent banks can.
Absolutely. All right, David.
Yeah, so looking forward, we want to go to the next slide and talk about market risk and the market expectations. So obviously pricing trends have really are in a much different place than they were in back in March of 2020. So we're really looking at kind of where they're headed and the bulk activity that's taking place. We're starting to see some increased activity. We're going to talk a little bit more about that in some detail, and really how that, we're back to pre-COVID levels. So it's been quite a rebound since March of last year. And that's really resulted in a number of people starting to look at putting MSR bulk transactions together that really haven't in the past. And then, of course, the impact of looking at, people moving from actual servicing to scheduled servicing. We'll talk a little bit more about that as well. So, Phil, I think you want to cover the next slide on retained
Sure.
released.
Sure, absolutely. Yeah. So, the big story for most of our clients at MCT was this graph here. That this tells the story in a nutshell of what happened as soon as the pandemic hit, and that kind of brown manila-ish line is what they were selling to aggregators, and you can see. And these, by the way, are our clients who could sell both, who were selling both to aggregators and to Fannie and Freddie. So we took out the ones who didn't have Fannie Freddie approval, or some of our bigger clients who routinely will keep 100% of their product as servicing and sell everything to the GSEs. So these are the ones who kind of took the choices, and you can see, normally, at least at the start of the year and at the end of 2019, they were keeping about that blue line is what they were retaining, and they were retaining less than 40%, 30% maybe or more. And I would say if we extended this chart back to 2018, that blue line might go as low as 15 or 20%. There was a very strong aggregator bid back in 2018 and the beginning of 2019. Once the pandemic hit, though, we all, and Matt has spoke about it earlier. The aggregator bid, due to the uncertainty of what the value of servicing would be, it fell dramatically, and frankly, if you did a best execution at that point, that blue line going to 70% maybe should have gone to 100%, because there was almost every loan made more sense to retain than to sell. But for a variety of reasons, there was still some selling. I mean, part of it is the clients who had the ability to sell to Fannie but were really not doing any. They had to kind of reamp their relationship with Fannie Mae and start up. That delivery is a little different. You're retaining servicing. You're not shipping the whole loan as you would in a Fannie Mae transaction. You might be shipping some material to your subservicer and other material to Fannie Mae. So it's a little bit, it's not that difficult to process, but it's different. And they had to remember how to do that. But I'd also say, if you remember back in March and April, the figuring out how to deliver to Fannie Mae was low on everybody's priority list, because everybody, and John, you probably had this problem too. You're trying to get rid of your non-QM, and the non-QM bid had gone away, right? And so you're as running a secondary market, you got to find buyers for those loans, and in the meantime, Matt, you're probably worrying about funding all those margin calls that suddenly came up on your TBA hedges that were all so, it's so easy to forget, but March and April, there was a whole lot of fires going on. So kind of smoothly transitioning from 30% to 70% was really not the case. It was a much bumpier, but it's nevertheless, it happened very fast. Since then, though, the aggregators, as the market has settled, we've seen the aggregators return to the market. As I was talking about earlier, our projections and maybe most other aggregator projections were maybe more conservative at first. Now they're seeing the reality of the forbearance not quite as bad as we thought, and the fact that the agencies were stepping in and forbearance permissions by FHA and rural housing to do partial claims, and all of those things were making ownership of servicing appear less risky. And you can see the aggregator bid has come back quite substantially. It's interesting that the blue line hasn't gone all the way back to where it was pre-COVID, and part of that is once you get selling to the agencies directly, it is an easier process, and the aggregators who, those just, those are the big buyers of whole loans who will sell themselves directly to Fannie Mae. So the institutions like PennyMac and Wells Fargo and those giant institutions who have normally will be normally buying the majority of the market, and even today are buying a significant minority of the market for our clients. So that bid has returned largely, but the habit of delivering to the agencies has not completely diminished. Part of that is that the margins have been so big in 2020 that cash needs to fund your LOs and to fund your operations and pay your leases is being met. So you're able to retain more servicing. Normally, you would have to sell that servicing, even if the economics might have indicated to retain it. You still might have sold it anyway, because you have to meet your cash needs as running a business. John, do you have any thoughts on that, or Matt on this whole adventure we've had the last year? Does this kind of match what I said? Match kind of your experience?
It does.
I as you said, Phil, I almost prefer not to remember it. It was very, very rough time, very challenging on many, again, especially for a smaller independent mortgage bank. It was a really tumultuous time. Yeah,
for sure. Let's go to the next slide. See, so rolling into 20, instead of looking backwards, let's look forward a bit about kind of what challenges may happen. And this is really a 2022 challenge, but we have to get ready for it in 2021. And that is, the FHFA has ruled that they want to limit the amount of purchases through the cash window that you can do. You being a seller servicer can do to deliver to them. And so, the Fannie and Freddie are both capping your amount of deliveries at $1.5 billion, which is, if you do the math, that's what, a little over 100 million a month. So if your origination plans call for doing, in the hundreds of millions per month, you may find this, and you have been delivering through the cash window, you're going to be needing to look for alternatives. And the first alternative would be to, if you're selling to Freddie, to add Fannie, or if you're selling to Fannie, to add Freddie. So you have two channels with which to deliver into. That will expand your opportunities. And then if those options aren't available, or if that expansion is still going to put a crimp in your ability to deliver a GSE product, then you have to explore going into selling MBS directly, rather than selling through the cash window. And if you want to sell MBS through Fannie or Freddie, there's more rigor involved in it, more in the process of getting your best execution, creating your securities, and it also means you'll be under scheduled or scheduled actual in the case of Freddie remittance structure, which requires potential cash advances in the event of there's a P&I advances in the event of delinquent borrowers, and so that can create some impact on your cash reserves that were unexpected. On the other hand, you can sometimes get float value with your banks or your sub-servicer if you're holding your P&I reserves with them, and because you'll have a little bit more cash in the Fannie Mae and Freddie Mac pretty much sweep those accounts, and you get, or Fannie Mae certainly sweeps the accounts on the cash window, and so you get, you don't get any float value when they're on your P&I, but you may get some if you go to a UMBS, a Fannie Mae MBS structure. It also, when you're doing these structures, there are buy up and buy downs involved. It's kind of a higher level of delivery to the agencies, and that can also mean your servicing won't just automatically be 25 basis points, which is kind of the standard when you're doing the cash window deliveries. So So you may end up with more or less, and you have to analyze what that excess is worth to you. So it becomes a more complex exercise. So if you're anticipating needing a scheduled delivery, you should talk to your hedge advisor and kind of, at MCT, we are already kind of setting up and preparing for that to do optimization under a scheduled environment. With that, maybe Matt and John, you can give us some color on your approach to some of these cash window limits and how you're anticipating it.
Sure. We actually started with MBS before we even sold cash window. So we were doing that early on, probably 8-9 years ago. It won't be too big a deal. We still have the MBS execution in our best deck, so we bring in the buy down grids every month. So we should be good to go on that. It's really nice being able to sell cash. So I mean, especially when that's why we switched to cash, is because the execution got so good. And historically, I think MBS has always been pretty much better than cash, but it kind of flipped back around 8 or 9 years ago, and cash really got good. But so that's, it's, I think it's a $1.5 billion for Fannie and another $1.5 billion for Freddie. So we'll have $3 billion to go cash, and then, like you say, I guess gear up the MBS securitization execution again. Yeah, it's 5-year swap, I guess. That'll improve your float. It's gone up quite a bit, on MBS. That'll help. If prepays go down, the interest lost on payoffs won't be as bad. But yeah, maybe MBS will end up being a little better execution down the road. So we'll see. But
yeah, it's
good to have that option.
As a smaller independent, this is going to sound strange, but we love this implementation of the delivery limit, because we have these hopes, probably irrational hopes, but these hopes that it's gonna force our bigger competitors to have to be a little bit more competitive. We're hoping to see some pressure in some other areas that helps us to be more competitive, because we're not generating enough to hit that limit. So for us, the cash window, remains that great option. As John said, it's an excellent path. It's so efficient, and it's such a quick form of execution. And we're not yet near that delivery limit yet. So for us, it's kind of, to some degree, business as usual. We hope it forces some of our larger competitors to have to securitize, maybe a little bit less efficient. We'll see. I don't know. But anything that makes it a little more uncomfortable for the big guys is a good thing for us. So
that's good. Yeah, I mean, there is some history involved. The reason why cash became better was that was a choice by Fannie and Freddie and FHFA. There was no longer prior to the failure of Fannie and Freddie in 2008, 2009. They had to compete with each other, and the G fees were fairly low, and they were trying to steal business from each other. And even though there was only two of them, at least there were two. Once they were in bankruptcy and FHFA kind of took over, and they had but one view on the world. The G fees went from 12 and 15 for the big guys to 40 and 45 today, the levels they are today. So it really, it made doing MBS that much less attractive. And since they were the only game in town, and there's only one guy at the head, the FHFA kind of setting the pricing more than Fannie and Freddie separately, they could kind of do what they want, and they wanted to do more cash, and then in effect, Fannie and Freddie could in turn securitize those loans, as they often did. Whereas now it's going to be back more on the individual seller servicer. But as Matt said, there's still a lot of runway, and Matt and John, both of you, you have some leeway there before you actually have to go MBS route. Okay, enough of these 2021 into the future. Let's get into we've looked at the past, we've looked at the future, and let's talk maybe the present and talk about bulk sales.
Yeah, I'd be happy to, Phil, kind of fill in some of the activity we've been looking at this year or so, and then we can certainly ask our guests their experiences as well. But certainly from March of last year to this year, as your slide shows, it was literally almost 100% retention there for some period of time for many of our customers as they went forward. And so that continued through the course of the year, although as your slide showed on the retained release, the release side started to get better and better over time, and it's becoming more of a closer decision to monitor, to take a look at. So what's the net result is that many people who had watched their portfolio grow 3 and 4 or 5 times what they were used to holding, and found themselves in a very different role of being an asset manager versus just an originations execution manager. So very different ideas to really come to the table and deal with as they look to manage the course of the year. So then, of course, this year, as production's gotten a little tighter, margins have gotten a little tighter, cash flow a little slower for some folks, we're watching people look at that asset that they built up and are starting to consider whether they should try to sell that or not. And certainly one of the activities that's making it more and more attractive is as that origination volume grows from, gets older, gets over a year and a day, then certainly the tax implications for selling change. And so I think that's one of the reasons why we're starting to watch a little more activity take place in that environment. Plus, there's been a lot of buyers, new buyers that have come into the market and are really looking to get involved. And so we've seen a lot of activity pick up in the first quarter and really are anticipating increased traffic as we go forward. And a lot of key drivers on loan sales, for what draws with the best price as you put a package together. Certainly the conventional business has been what's been attractive, that really the Jennies still are behind us at this point. And, in terms of really regaining their value pre-COVID. So I don't know, John or Matt, as you guys think about kind of the value of your portfolio picking up as rates rise and you start to consider, how to manage your books going forward, how does this information relate to you and how you're managing your books?
It's kind of, we've been doing that for about 3.5 years. We've, kind of tried to achieve critical mass before sale, something where it's enough to get some attention. $1.5 billion, $2 billion. We've had, I think, 3 sales in 3.5, 4 years. And as of right now, that's probably, kind of a strategy going forward to,
Gotcha.
Let it get some seasoning, 12 months, maybe even, those cash flows are pretty stout the first 24 months. And I think it just kind of feels to me that maybe there's still a little more room for market improvement, given where we are with rates today versus where we were pre-pandemic. And, with Fed expecting 6.25% growth, it just seems like rates they feel like they're going to be going up.
Gotcha.
And So, I mean, that's what we do. That's what we've done. Like you say, nothing's in stone. I mean, we have to change it around. We, turn on a dime and do it again.
Yep.
But yes, I
And
mean, we were releasing most everything, early 2020, and over the course of a week or two, started retaining 100% of everything. So,
Yeah, you were
David,
that dramatic grafter, so.
yes.
yeah, David, you might want to pull up that next slide for us as well. So it'll kind of, yep. And then Matt, do you have any comments as well on the bulk sales and perspective from your side?
Yeah. I mean, I think again, just as John was saying, this your strategy is always subject to change. But look, we live in a world of incredible disequilibrium. I mean, this mortgage marketplace is probably one of the most volatile sectors you can imagine, and so when you have a natural hedge, kind of this natural insurance policy of your portfolio, the reason you hang on to it is because you need to be prepared that during that down cycle, you want to be in a period where that MSR portfolio is gaining value, because sometimes cash demands require a bulk sale. Sometimes you need it to fuel the business during the down cycle, and so for us, our MSR strategy has really been centered on bulk sales as our fallback position in situations where the market deteriorates. The great thing about where we are right now is, it's really hard to envision that that the servicing that we've retained is going to really do anything other than just increase in value, because it's really hard to see, at least for the next several years, based on the macroeconomic outlook, that interest rates are going to go back down to where they were. I mean, I hope I'm wrong. We had a good few months here behind us, but without a return to those kinds of rates, so much of our origination now has a very high intrinsic value, because it's highly unlikely that we're going to see borrowers prepaying and jumping out of the out of the loans that they currently have. So the value of that servicing gets ever more valuable. I suppose the only small additional nuance that I should add to this is that your strategy can be a little bit different for your bulk MSRs, depending upon whether you're talking about a Fannie Mae portfolio or a Ginnie Mae portfolio. If you're talking about Fannie and Freddie, you have a little bit of a different borrower profile from that of a purely Govy type portfolio. The Govies don't age as well. You tend to get a lot more delinquencies. The profile of borrowers tends to be a little bit different, and so sometimes you may have a different strategy for different pieces of your profile going forward over time. You may want to undertake a bulk sale quicker on a Ginnie Mae portfolio than you might on, say, a Fannie or Freddie portfolio, for example.
That's, yeah. All words of wisdom. Of course, if you go out with a Fannie sale, you'll get more bidders, and they'll be crawling over each other to get that Fannie Mae deal. Ginnie Mae has bidders, but they're not as many. And typically, the term, since Ginnie Mae involves advances, it involves delinquencies. When you have a servicing transfer, the whole pool has to transfer. And so if there are elements of a pool, if there are delinquencies in a pool or forbearances, whereas with Fannie Mae, you can pick and choose which loans you wish to sell and keep the other ones, and so that you can have a very clean transfer that your buyer wants. With Ginnie Mae, you've got to transfer that whole pool, and there may be some an ugly loan amongst other good loans, and that will often create difficulty in transfer and sometimes in returns as well. And that, yeah, I know I've worked with you on some on the Ginnie Mae transfer that part of it went very smoothly and part of it not as much.
Yeah. Well, no fault to MCT, I must say, on that. You guys did a fabulous job of helping us understand the nuances and the differences in the different bulk sales that we did over the last couple of years, Phil. But yeah, I mean, it's a great fallback strategy to undertake a bulk sale. But again, I think if had we not had help and counsel from MCT in that transaction, there's no way we would have made the money that we made, because again, we might do a bulk transfer, a bulk sale, every couple of years, every few years. The people we're selling to are doing them, every day, and their level of sophistication about that transaction and how to make sure they extract, the better end of that bargain, far outweighs our own level of experience. So that's where I think you guys really, came in to help us in a great way, and help bring some sophistication and expertise to the table in those transactions, without which I think we would have left a lot of money on the table, frankly.
Okay. David, you want to go to the next slide to summarize that?
Yeah, as far as sorry, we had a little outage here for a minute. So all excitement on the technology end, just got back in. But in terms of looking at MSR resources relating to, the last two slides that we covered, I think one of the things that people may be unaware of is really the treasure trove of information that's available on MCT's website of recent and thoughtful articles that really relate to the most current challenges that you may be facing in the MSR arena. So several examples here: the MSR forbearance in 2020 and what the challenges and recommendations are. One that we've received a lot of attention on is tax and cash implications of creating excess servicing. All these articles were written within the last probably 90 days. And then the market update for the fourth quarter for MSR sales. And then, of course, our case study with Doorway and how that worked out and how we were able to help participate in the market there and deliver, a superior sales activity to get that package sold. And then servicing insights, particularly on recapture. I know it's a big topic these days as people look to hold on to that portfolio that they just recently gained. So with those are some resources you can take a look at. And then with that in mind, Phil, I know one of the big options that we're talking to folks about are retained to release considerations. Did you want to open up on that?
Yeah, sure. I'll touch it. That graph we looked at earlier that showed the brown line going down, selling to the aggregators versus the blue line going up, retaining more. Those are kind of dilemmas that a vast majority of our clients and probably a lot of people on this call have to face every time they're doing a loan sale. So should I sell to Wells or PennyMac or Fannie and Freddie? Typically the Wells and PennyMac prices will be higher because they are essentially buying that loan to sell to Fannie Mae, and they also value the servicing. So they're kind of paying for two elements: the loan, underlying loan, and the value of the servicing. Whereas when you sell to Fannie Mae, you're just getting the Fannie price, but not the value of the servicing is what you've got it. It's on your books, but it's an asset. It might be worth $1,000, but if Wells is going to pay you $1,000 day one, that's cash in your pocket, and so you may wish, even if the economics indicate retaining the servicing, you may say, well, but what about my cash? And that is, for the non-bank, for the companies like Matt, the small but nimble non-bank mortgage originators, they have to watch their cash, and so we have designed tools at MCT, and that we think the way you ought to look at those retained decisions as, you know, what is that internal value of holding that servicing to you? You know, we should kind of look at your actual internal costs, and then are you financing the MSRs? If you have that ability, that's going to change your cash decision. What about the tax? Because if you hold servicing versus selling, you know, when you sell that whole loan, you get taxed as a gain on sale day one, right away, the whole transaction. Whereas when you sell to Fannie Mae, you're only taxed for that portion, and the MSR that you've created, you don't pay tax on. You will as you earn that servicing fee over time. So you've essentially deferred that tax. Instead of paying for it day one, you pay it as you earn your 25 basis points year after year. So those kind of jiggling and differences, financing, figuring out what kind of cash position you're going to expose yourself to by not doing that transaction with an aggregator. It really needs to consider things like, are you financing? What are the tax implications? What is the true internal economics you're going to be getting on that loan? When you factor all that in, then you start ranking, not just, you know, it's not just the pure ranking of economics from top to bottom, but it's really, okay, I understand the economics, but what about my cash? When am I going to get enough cash back to offset the cash I've lost by not selling to Wells or PennyMac? So those are not simple considerations, and we've designed software to kind of take all that into account and help. We have a number of clients who are utilizing the software to make their retain release decisions more precise. David, unless there are any questions, any comments on that, I think you can sort of take us to sort of our summary of all the takeaways for the MSR market. You still there?
You're on mute, David.
Yeah, sorry, I had my mute button on. I apologize. So the interesting part to me is that when we've had those conversations with our clients about retain release strategy, one of the issues has been very often the folks' intuition on what to keep or what to retain has really how it's interesting how it's matched up with kind of how the numbers turn out when you really consider it from a cash flow standpoint, and you consider really what the tax implications are and the break-even point is to really sort that out. So it's been one of the, and as the market's been tighter between released and retained product, it's really been very, very useful to kind of go through that exercise and clearly identify what's the best loan to put in your portfolio. Because right now you certainly want to, it starts with making a good decision to what loans go in terms of what portfolio your value you really end up with. So that's one of the key things that we've been watching, and a key takeaway is really to take some time to really take a solid look at that retain release decision. And then the bulk market, we're watching that market really heat up and get active and really start to open up. And I think there's more room to run, as John pointed out earlier, but because of the kind of folks that are not used to really holding as large portfolios as they have on their books, and because there's lots of buyers who actually really want to look at acquiring and growing their portfolios, it seems that the market is really started to heat up, and we've certainly seen that from our end. The number of participants and the number of deals that are in place are really going strong. So, and then looking at the other thing is to take a good, careful look at your subservicers and if they're compliant to CFPB. Also examining what all the new charges look like that they may have based on all of the different regulatory and investor requirements that have come out. Those are certainly things that are up for conversation, and you should engage your subservicers on. And certainly if you need some expertise in that regard, we can certainly help out. And then forming strategies around servicing portfolio management. What is it that you really want to keep long-term? What is it that you really want to hold or try to sell? Or what products are best for you to maintain or to move forward on. Really some of the takeaways in terms of kind of how to look at your business, and also the ability to take a look at what you think, where delinquencies might head, where the rates might head, so you can shock your portfolio and take a look at it from a delinquency basis on different market conditions, on rate basis from different market conditions, and really decide where that puts you, particularly as you have to report to board members and others alike. So, because it's obviously a very different job becoming an asset manager versus just managing origination pipeline. So I don't know, Phil, did you have anything to add to that?
Yeah, I guess, the one takeaway I'd like to throw out this, I have this conversation with a number of clients when they start retaining servicing, and they're one of their early questions are always, well, what is the best loan to retain? And there's always a little education in servicing that, the best loan to retain from a servicing standpoint may not be the best loan from an origination standpoint. So if I'm Fannie Mae, I want to buy a 800 FICO 60 LTV loan. That's my favorite loan. And when you're an originator, you want to make Fannie Mae happy, so you originate those loans and sell them to them. As a servicer, though, that's a wonderful loan that will never go delinquent, right? You're going to get that payment every week or every month, and your servicing costs will be minimal because you don't have to worry about delinquencies. However, if rates should move down just a smidge, just an eighth or a quarter, 10, 20 basis points only, that borrower is going to get a million solicitations because, look, a 60 LTV 800 FICO is on everybody's radar. And if they happen to pick up the phone and ask with one of these brokers or other originators, or even there's so many people, so many originators that want that borrower. And when you want to underwrite that borrower, he or she is going to go through AU engines and 1 minute flash, come out approved. The docs will be drawn. This is this loan is so easy to refinance. It'll be done in 1 day or whatever. You don't have to lock it any longer. So that type of loan, and it's great from an origination standpoint, from an investor standpoint, but from a servicer standpoint, maybe not so good. Sure, they paid every time, but they were gone after a few months or a year or whatever, as soon as the rates moved. So when you look at that servicing asset, you just have to look at it a little bit differently than you look at it as from an origination standpoint. So that's maybe one of the takeaways. We try to utilize all those factors. And you don't want to have a portfolio full of delinquencies, but at the same time, the super best loan from a Fannie Mae or investor standpoint may not be the best from a servicing standpoint.
So as we kind of wrap up a bit here and we look at MSR Market Takeaways, I just thought either Matt or John, kind of as you look to manage your books for going forward this year, any particular takeaways you would leave the audience with in terms of what you'll be focused on and looking at as you move forward?
Go ahead, John.
Oh, go ahead.
Yeah. I mean, look, I think in general, we're the key thing, and John pointed this out earlier, is you just got to keep your eyes on the portfolio closely. We work with a sub-servicer, a good sub-servicer that we're happy with, but you can't just take a hands-off approach. You got to be actively looking at the trajectory of your servicing customers. You got to be watching over it closely. Don't take it for granted. And you really have to be thinking about how much servicing you're capable of taking on versus the the cash flow constraints, and also how much cash you can get for the asset in the market. If in the end your discounted value of the cash you can make in the near term by selling up front is better, well, then you have to think about potentially doing that and mitigating the risk of holding it. But on the other hand, as we pointed out, throughout this session, there's great value in having that that portfolio available to fall back on during the rainy days, which are bound to come, at some point in the future. So I think as long as you're actively managing it, looking at it closely, it's a tremendous asset.
And I just, kind of add that if you are going to sell it, get a list of questions from your sale advisor of every possible question that the bidders have asked over the last 3 years, and in advance go through your portfolio and answer all those. I mean, the time that you go to market will be a little different, and your UPB will be different, but you'll have a lot of these questions answered. And I recommend you track your single monthly mortalities, your prepayments, and just have a world of information to give all the bidders when they start asking for it. Because I mean, if there's anything that hurts a bit, it's uncertainty around a question maybe that didn't get answered or whatever. The more information you give them, the tighter they can get their bids. I mean, I've been on that side too, and there's nothing like having history of whatever advances or prepays, and every field that they're going to ask for is they're going to ask for everything. So if you can get that, and if your servicer doesn't have that field, maybe have somebody start getting it out of loan files or whatever, and putting it in a spreadsheet to submit with all that. But it just makes your life a whole lot easier when especially on Ginny pools, and make sure those pools are all certified, final certified, because they won't transfer if they're not.
Yeah, absolutely. Well, thank you for that, John.
Okay.
I know, Phil, do we have any questions that we want to try to address, or I know we're getting close to our time?
Yeah, David, this is Bill. We've got a list of questions. We're running out of time, but I'll try to prioritize them, and we'll answer them separately if we're not able to get to them. But the first question is about the bulk activity. Several folks mentioned an increase in that activity, and the question is around multiples and pricing. What are you seeing currently in the market? And then are the buyers back in full force?
Yeah, Phil, do you want to address that one?
Sure, yeah, I would say on the conventional side, we are getting very strong bids, because if you think about the 2020 portfolios right now are coming out, and so they're having average interest rates on the 30-year product under 3%, whereas the market, as we all know, is around 3.25% and maybe even higher these days. And so that has attracted a number of bidders. The usual
Phil, did we lose you?
facts plus a few more, and so that those are prices. I'm talking.
Yeah, now we can. We lost you probably the last 3 seconds.
Okay. Well, I was just saying that the multiples are fully back for conventional at their pre-COVID levels, and well through 4 for a 30-year portfolio under 2% WAC. The Ginnies are also stronger, and there is some interest in higher coupon Ginnie Maes, which sounds weird, but there are a number of buyers who are able to streamline, refi, and do IRRRLs, and they see that value, and so that bid has been a little bit stronger than you would have otherwise have thought. So the bulk market, the short answer is it's much stronger than last year, and we're seeing more participants than we did.
That's great. Thanks, Phil. The second question is about portfolio valuations. And the question is, we are a public company and currently only receive one quarterly valuation. Would you recommend that we obtain a second opinion on our MSR portfolio, and why?
Well, I would say if you're not using us, then you need a second opinion. No, seriously, it really varies. It depends how large the portfolio is, how impactful it is on your balance sheet, and so it's not a it's I can't give you a general answer there. I would say the majority of our clients are sticking with one quarterly evaluation, but there are some who use more than one service providers.
And Talia, I know we're out of time now. Like I said, we will respond to the other folks that submitted questions and make certain that we address them. But I think we're at the top of the hour. I didn't want to be respectful of everyone's time.
Yeah, well, thank you guys for all of those really great insights, but we have come to the end of the webinar today. I want to thank our great panelists and of course you, our attendees, for joining us. If you did submit a question that we didn't have time to get to, the panel will be able to reach out directly to get your question answered. And as a reminder, HousingWire will be sending out the recording and presentation deck within 24 hours, and it will also be available on our Knowledge Center at housingwire.com. Thanks again for joining us, everyone, and have a really great day.
Thanks, Talia.